Hello, everybody. Kirk Spano. It is Wednesday, December 18th, 2024, and we are going to talk about 2024 and 2025 and 2026 and a little bit beyond. So why don't we get started? Two investment letters, Margin of Safety Investing over at Seeking Alpha, published the annual outlook, about 4,000 words and a lot of pretty charts that we're going to go through tonight. Overvaluation and uncertainty is a path to correction in 2025. And I've been talking about getting lighter on equities and risk assets, in particular large caps, for about 3 months now. And since the election with the rally, have accelerated getting out of a lot of positions, have run my cash up to about 40% of portfolios, give or take, depending on the portfolio, and was looking for a correction. And what happened today was a little bit quicker and more than what I expected to happen today. I thought this might happen in January or sometime in the Q1, maybe even Q2, but it looks like we're ahead of the game. So same set of articles there and at Fundamental Trends. Fundamental Trends calling it the 2025 futile forecast. And that's really what I go with on my website, the futile forecast, because ultimately it's not really about prediction. It's about laying out scenarios that you can understand and have a plan for. And then it becomes about reaction. So people who glom onto a predictive idea and then they justify it and rationalize, even in the face of being wrong, usually get beat up the worst. So understand the myriad of things that could happen and have relatively executable game plans for if they do happen. The one thing I will tell you is unless you are a really good trader, there's not much hedging to do, even in the face of a down market. What you do is you fix your asset allocation and you raise cash and go to assets that work in the opposite direction of the stock market. There are a few. So I wrote an article this week on Seeking Alpha. I hope you go and read it. Stock market euphoria and 200,000 Bitcoin, what I got right and wrong in 2024. As you know, I predicted a 20% rally. I had the second highest prediction on Seeking Alpha for where the stock market would go this year. I said 57.20, which was way above the street. Highest being Yardeni at 5,400. Everybody else between 42 and 5,200. Everybody, Morgan Stanley, Cantor Fitzgerald, BMO, Citigroup, Deutsche Bank, Goldman Sachs, even our good friend Tom Lee over at Fundstrat, I was higher than by 500 points. And of course, until today, we were a little over 6,000. I don't know if we are under 6,000 right now or not, but we're really close. So I'm going to end up being first or second most accurate. If we get a 4 or 5% correction between now and the end of the year, I might be spot on. We'll see, but there are a lot of reasons why I thought 2024 would be very bullish, including the presidential cycle. But more importantly, I liked the fact that we were building back better a lot of things. Even though people get irritated about inflation, the reality is we've been talking about inflating away our debt for 15, 20 years now. So it wasn't a new idea that we would get a bout of inflation at some point. COVID largely made it happen because the bailouts were bigger than they needed to be. Never let a good crisis go to waste. It helps mitigate the baby boomer retirement crisis that's coming at the end of the decade, which is really the big boogeyman, is what do we do about being 15 to 20 trillion short on Social Security over the next 30 years, 35 years? And what do we do about running $500 billion to $1 trillion deficits on Medicare until the middle of the century? The answer is we fix them. It's not slash benefits, it's fix the systems. They're very easily fixable. We just have to get over the ideology and rhetoric. Did an interview on the Investment Experts podcast on Monday when I said stock market probably have a correction very soon, and it happened on Wednesday. At least it looks like it started on Wednesday. Maybe that was a one-day thing. By the time you see this on YouTube, we'll know a little bit more. But I hit on a bullish year in 2024. I think that 2025 is going to be choppy. I don't know exactly the shape of the curve. I do expect at some point that we get a 15 to 25% correction in the S&P 500, 500 biggest stocks in the market, which are probably more predominantly profitable. The Russell 2000 probably gets beat up worse because less than half of those companies are profitable. However, the Russell 2000 is where you find the biggest winners year over year. It's very rare that the top 50 stocks in the stock market don't include 30 or 40 off of the Russell 2000. So, despite that index of 2000 stocks being crummy, you usually can cherry pick the best winners out of it. So, overvaluation and uncertainty is a path to correction in 2025. Why? Market conditions are uncertain because the economy and policy are uncertain. It really comes down to that, combined with significant overvaluation in the S&P 500. So despite those being pretty good companies, you have valuations that are not in line with growth, especially across about 200 of them. So you've got about 100 really, really good companies, 200 pretty good companies, and then 200 companies that just because of their size are on the S&P 500. But for the most part, 200 companies that are not growing or outright shrinking. So you don't really want to buy the S&P 500 index either. There are better S&P 500 based ETFs out there to use besides SPY and VOO. Subscribers know what those are, and those are the ones to use. Generally beat the index by 2 or 3 points per year by focusing on the better companies. So we're going to take a look at some key indicators to let us know really what's probably coming and what the range of scenarios will be. So without further ado, let's jump into the charts and rub my crystal ball. First one, let's take a look at valuation. What we can see here is the way that the market is broken up. You have your small and mid caps down here, large caps, and then the 8 mega companies, the ones that are just huge, your trillion-dollar companies. And you take a look at the valuations. Now, a price to earnings to growth ratio, or PEG, should generally be between 1 and 2 for a healthy company that's growing. Down here, this is probably right based on the whole index. But there are companies that are growing at 40, 50, 60% a year. They realistically can have a price to earnings ratio of 100 if those growth rates are expected to be sustainable for 3, 4, 5 years. So on these smaller caps, you just have to cherry pick them. The index is not ever what we want to invest in, ever. We never want to invest in IWM or other small cap ETFs, with the exception maybe of a momentum-based ETF, because that is just basically jumping on the winners and following a trend. So if you are in an ETF strategy, you want small cap exposure, there's not a correction going on, you buy the momentum-based small cap ETF and you ride it while the riding is good. The rest of the S&P 500 has a PE ratio over 22 right now, but the growth rates are single digit. So you have a PEG ratio of between 3 and 6 on dozens and dozens of companies. That is grotesquely high. The Magnificent 7+1 up here with PE ratios in the 30s, they are borderline justifiable because most of them do in fact have growth rates between 10 and 30%. So they can get away with that. NVIDIA really being the only one that's got a really high growth rate. But Apple has a growth rate of under 10% now. So their PE, even with their balance sheet, should probably be right around 20. And if you take a look, it's not too far off of that, actually. The equity risk premium is typically 2 to 4%, and right now is 0. So we have a very low equity risk premium. You can see in 2007, it was a little under 2, and we got a huge correction. 2000, it was below where we are now, and we got a huge correction. And it really hasn't been this low since the financial crisis. There is the potential for a 50% stock market decline. I don't think it's going to happen this coming year, but we should be aware that it could in fact happen. Market valuation methods, 4 different ones. Crestmont PE, cyclical PE, otherwise known as Shiller, the Q ratio, which is a lot like the Buffett indicator, and then S&P composite from its regression. If you take a look, depending on which measure you're using, and I actually like the cyclical PE, I like the Shiller PE, everybody rips on it, which means that it's probably the right one to look at, is a good indicator of forward growth over the next 5 to 10 years. When it's way up here, you usually get significant correction. It played out fast this time off of a record, and we're in the second highest spot ever or the highest spot ever on all of these measures, going all the way back to the Great Depression. Now, financial systems changed in 100 years, so it probably doesn't make sense to be completely tied to this chart, but for relative viewing, you can see stocks are very overvalued. Does that mean they can't go higher and set a bigger record, a bigger historical anomaly? Oh, sure they can. The market can remain irrational longer than a short remains short. Interestingly, there are not a lot of shorts out there right now. On the small caps, they're ganging up, but there aren't a lot of people short the S&P 500, which means there's room for that. This is the famous Warren Buffett indicator, second highest point in history, and probably largely explains why he has raised $100 billion in the last 18 months, to the point where he has $250 billion in cash and short-term bonds, dry powder, representing about 15-20% of the total value of Berkshire Hathaway, which is one of the trillion-dollar companies now. So the idea that this won't revert at least part of the way back to the mean is really nonsensical. Now, can we have in the age of QE kind of a mirror image, a standard deviation or two out? Absolutely it does. And I don't believe we're anywhere near the end of quantitative easing. We're going to get more quantitative easing, maybe twice more, just by the end of this decade. What is quantitative easing? It's when the Federal Reserve, essentially, people call it printing money. It's not. It's a super long-term loan that we manipulate and we pay ourselves the interest. So kind of printing money. We can see the market stay in this area, I think, pretty consistently for a long time, but it probably has to pull back somewhat. Consumer sentiment is off the charts. People are spending money. I don't expect that to last terribly long because we know that the banks are starting to tighten up on credit. This is lending standards, and they're tightening up on commercial loans. Or actually, they haven't. They've loosened up lately. But up here, this is the first time that they tightened up significantly on lending, and we did not get a recession. So the question becomes, and this is largely tied to commercial real estate crisis going on, will this pop up and will the banks tighten? If they do, we probably get a recession. If they can keep this in this area, we have hope of avoiding a recession. So let's talk about the indicators that would make us think that we're on the verge of a recession. Remember, I said for 2 years we'd have a soft landing. And then in June, I said we did have a soft landing. And then in October, the leading economic indicators said we had a soft landing. So I've been pretty ahead on this. In 2025, we just don't know. We are not really sure. So this full-time employment level, anytime that it pulls back, we have gotten a recession, pretty much 100%. And right now, full-time employment year over year is about flat. If it turns down, recession. If it holds the line, and I don't know that it even has to go up, but if it holds the line, I think probably we avoid a recession. And why do I focus on recessions? Because every recession, there's a stock market crash. So if we know whether or not there's a recession coming, we know if there's more than a nominal correction. And for me, any correction under 20% is just amplified volatility. Single digit corrections, volatility, 10 to 20%, that's a correction, but it's not super damaging. It's really a pause that refreshes usually. And that is kind of the side that I'm on in 2025. Recessions bring on corrections that are 30, 40, 50, 60, 70% though. And given valuations and the narratives and the sentiment that's out there and the reflexivity of investors to panic and oversell, just like they overbuy, means that even though the stock market probably should be worth a little bit less than it's trading for now, we could overshoot that if we get a recession and people panic and they forget we're just going to print more money, which is what we'll do. So we need to watch the employment. One thing that could turn employment down is if they really can accomplish mass deportations and they really pursue it. If they're smart, and I'm not sure they are, they aren't. It's hard to tell sometimes. If they pursue mass deportations, they will shrink the economy, we'll have a recession, asset prices will get crushed. No ifs, ands, or buts about it. There is really no argument against what I just said. If they focus on the criminals, and illegal aliens are not all criminals. Criminals are people who commit crimes. Coming across the border without papers, that's like a civil offense. Give you a little fine, send you on your way, go fix it. Killing somebody, robbing somebody, right? Dealing drugs. Those are the criminals. And we know that there's probably 50 to 100,000 new criminals in this country over the last 4 years. That's who they should go after. And if that's what they focus on, it ends up being a net positive for society at multiple levels. We get to keep the labor. We get more young people having babies, and we need it because of demographics. And we Americanize all these people, and we throw out the criminals. So let's keep an eye on that. Let's see what happens. Tom McClellan is one of the more famous technical analysts out there. I watch his stuff pretty closely. He points out, and this is just so people can keep an eye on what's going on, if tax receipts are not between 16 and 18%, if they're too high or too low, we tend to get a recession. So there is a balance between 16 and 18% that we have to maintain. As you can see, we're just barely above 16%. There really isn't much in the way of tax cuts that we can do without pushing this down too far and really nailing the deficit, really just hurting the deficit badly. You can take a look that from the tax cuts to 2021, they did not pay for themselves. There is no mathematical equation, no documentation, no empirical evidence anywhere that the Trump tax cuts, or for that matter, the Bush tax cuts, paid for themselves. They did not. Now, people always argue, well, Kennedy and Reagan cut taxes and they paid for themselves. Yes, but that was off much, much higher tax levels, much, much higher tax rates. We have relatively middle of the road tax rates in this country. There just isn't much to cut. And if you do, you're going to blow a bigger hole in the federal deficit, which is what a lot of people are complaining about. So in order to maintain the soft landing, we have to show monetarism, centrism, keep it close to the middle, which is about where we're at. I do think there are some interesting things that President Trump is uniquely positioned to do, but just giving random tax breaks is probably a bad idea. And we know that tariffs cause inflation. Why? Because it breaks supply chains, toilet paper, cars, heavy machinery, all the stuff that you were waiting to come over on a boat, right? That became a famous saying, oh, it's on a boat somewhere back in 2021. That would happen again. And there would be retaliatory tariffs. So while tariffs can be a tool, for the most part, it's pretty played out because the last 4 presidents have all done it. And just like taxes have come down to a moderate to moderately low level, tariffs are at a moderately high level. You really just can't go much higher. So we'll see if he breaks the tax code or he causes inflation with tariffs. We did get the soft landing as I described. Back in June, I said it. And I said it was coming. In October, NBER agreed with me. And the conference board agreed with me. So again, we've been ahead of what's going on. So I ask you to understand that for the most part, just by reading all this stuff, we can figure this out ahead of most of the public that doesn't read any of this stuff. That's your edge. Your edge is that either you're doing the reading or you're relying on me to do the reading, or at least get pointed in the directions to do the reading. In my article, I have a number of links. I'd encourage you to jump over to them. One of the things to keep an eye on is the growth of the money supply. And people always talk about, oh, they're devaluing the dollar. Yeah. They've been doing it a long time, since World War II, actually. But it's been on a relatively benign path. The growth of the monetary supply, of the money supply, M2, has been rather predictable. And that red line I put in there, that's the trend. And it probably ought to go all the way out to about 2050 instead of where I have it. So it should be stretched out maybe just a little bit. But when we have a recession, you'll see that we trend above the line. Recession, go above the line. Recession, go above the line. Soft economy after the financial crisis, we stayed above the line. This is the age of quantitative easing. COVID, way above the line. So for the last 2.5 years, the Federal Reserve has been doing something called quantitative tightening, not QE, but QT, and bringing it back to the trend and slowly bending it back up to the point where financial conditions are actually pretty loose. They're not as loose as they can be. We've been a little looser a couple times, but financial conditions are pretty loose. We would expect either for them to continue down and then go back up as the economy overheated, or you could be seeing the Federal Reserve talk the market into tightening up a little bit and throwing a temper tantrum, which is maybe what they did today. Market was down, 3 or 4%, pulling this up a little bit. Why? Let's have some conspiracy theories. Now, most conspiracy theories are bunk. However, every now and then a conspiracy theory is right. And if nobody believes it, that means the conspirators have won. Somebody somewhere along the road told you, or you heard, or you read, Never let a good crisis go to waste. And I believe that's what COVID was. They overprinted and over bailed out because, one, they didn't really know how bad it was going to get. Then even after they did know, they kept printing and kept bailing because they had a license to do it. Public was going to let them do it. And they know that there is a retirement crisis coming at the end of this decade. And then when the millennials retire in 20 years after that, there's an echo crisis. The thing is that the baby boomers have the millennials behind them, probably can get through it. But then how do we support the millennial retirement? We better start planning for it now. And this is where I think President Trump, that's the right thing to call him. He's the president. President Trump has a unique opportunity. He is popularly elected president. He won the popular vote by a little bit. Still the seventh closest election ever, but not as close as the last few. He controls the entire Congress and the judiciary. If he decided to do things that we know that are right for Social Security and Medicare, which do not include any cuts, simply means making them more efficient and planning for the future by funding them correctly, eliminating some of the problems that there are with Medicaid. Medicaid is really the problem child, not Medicare or Social Security. Those are just demographic problems, lumps in the curve. They smooth out eventually, but you got to get through it. I think President Trump has a chance, and I'm just going to mention it here. I'm not going to argue that he's going to do it, but I think he has a chance to fix Medicare and Medicaid and the healthcare system in general. And I think he has a chance to fix Social Security, which is the easier problem to fix. We'll see. I'm just saying there's a potential for positive surprises the next few years, next two in particular. But in the very short run, in 2025, the odds of the financial tightness and looseness getting looser are pretty slim. It almost has to tick up for a little while, kind of like this sort of thing, a little jitterbugging up towards the even line. And if you're cash rich as this happens, you're going to get great deals on cars, on real estate, on jewelry at the pawn shop, on stocks, and probably on Bitcoin. Now, I have talked about real estate development, and one of the big employers in the country is building, construction. It's another reason we can't really get rid of a lot of immigrants, because they are instrumental in that labor force. And the financing and other activities, decorating homes, remodeling homes, everything that goes into spending on a home is important to the economy. It's a big hunk. Right now, housing units have been falling. Why? Because interest rates started going up. You have heard me talk about, if you've been here before, that I've worked on some $20, $30, $50 million real estate development deals. And because interest rates were a little too high, we couldn't get the deals done. And then right now, interest rates are ticking up a little higher in the middle and end of the curve, and we need that to come down. Right now, the 5-year treasury rate is 4.3%, 4.35%. And that means that the loans that banks are making are between 5.3 and 6% on a 5-year note. Why is a 5-year note important? We've been through this before. That is the length of time that most commercial buildings and multifamily homes are financed for. So while your single family home can get a 30-year mortgage, that's not how an apartment building works. You get a 1 or 2 year building loan and then a 5-year note. Then you refinance it again in 5 years. Back in 2019, the 5-year treasury rate was about 2%. And that's why there's a lot of commercial real estate loans in trouble right now, because to refinance, they can't get 3 and 4% loans right now. They can get 5.3 to 6%. And now that a lot of those buildings aren't fully occupied because of work from home, the banks are going to be on the hook for a lot of buildings going bankrupt and getting the keys back. I was in San Francisco a month ago, 2 months ago, I don't remember. Took a look at 6 out of 7, and I couldn't find the 7th one, buildings that were bankrupt. 3 of them were hotels, actually. 4 of them were office buildings. So interest rates need to come down about 1%, preferably faster than slower, so that this curve starts going back up. We need this not to come down. If it breaks this line, we're having a recession. We need it to start building its way back up. We need more housing starts. We need more multifamily housing starts. This is where the 5-year note is now. This is where it was in 2017, 18, 19. Needs to be in here. It's not a lot lower, about a point. If the 5-year note comes down a point, that's very, very good for the economy. If it goes up a point or even a half point, that's very, very bad. We're having a recession. Powell acknowledged that's what was going on in the press conference today. He goes, housing activity is very low, and that's largely because of Fed policy. So he knows, he absolutely knows that he's the one that can restart that. I expect that he will. The dot plots came in today at either 2 or 3 rate cuts next year. I think it's going to be 4 or 5. If you've been watching me for a few years, you know that I get this stuff pretty right pretty often. So now that the expectations have changed to 2 or 3 rate cuts next year, I believe they're too low of expectation. So now the question becomes, is if he lowers them 4 or 5 times, does that scare the market or energize the market? I say probably both in sequence. First scared, then hey, it's going to be okay. You can play that wiggling in the stock market line. So U.S. equity allocation is at an all-time high in households, meaning the little guy is all in. Meanwhile, corporate executives are selling at an all-time record. Warren Buffett is selling at an all-time record. And this chart here, the mutual fund managers don't have any money to invest right now. They've been investing for 2 full years. They're out. What does that mean in a supply-demand standpoint? It means there has to be a correction. This line has to go up. This line has to come down. People are going to sell the things that are most liquid, and they'll probably sell the wrong thing. They'll keep that stock that's down 30% because it's going to come back, but they'll sell the one that's up 100% because, oh, it's way up. They're going to jump off their winners to jump on their losers. If you were a jockey, is that what you would do? Hey, this horse keeps winning races. I'm getting off. That horse over there, he sucked a long time, jumping on his back. Doesn't make any sense. Ride your winners, sell your losers, and make sure you understand what a loser is. A loser isn't just a stock that's down. A loser is a company that's business isn't executing as expected. You have to make that distinction from price. Has the thesis changed? If it has, then do the smart thing. When the information changes, change your mind. This is Shooter's Elliott Wave chart, and I got him to simplify this, create some trend lines, and these are the 3 major trend lines. This is the one we've been rocketing up on for the last year or so. This is probably normal-ish, and this is also normal-ish. Somewhere in here is probably normal, and in here is acceptable, right? Close enough. Stock market probably has to come down to close to this red line. So below 550 on the S&P 500, down to about 500, under almost any condition. This red line is actually what I expect, because I think, again, this is where the conspiracy comes in. I think the Fed, which a few years ago said they wanted to cause a correction, this time they're not saying it, but I think they want it again. Because valuations are too high, that's what we started with. Stock market comes down 25% to around this area. That's what that would be, a 25% correction. Now the Fed can lower interest rates a little quicker, maybe tap the brakes on the quantitative tightening. Then we probably have anywhere from a 3 to 12-month correction at some point. Hard to know the time frame. People are stubborn. Judging by how fast they sold off today, maybe it happens in 3 or 4 months over that time frame. In which case, because of, can I get it right? Oh, missed. Oh, missed. That one. Because of this increasing money supply, probably not likely to have a real bad recession, even if we get one. But any recession, any threat of recession, any fear of recession gives the Fed excuse, license to get to printing again, or at least turn off the money unprinting, right? Because this is unprinting, right? It hasn't gone up over 2 years, 3 years almost. You need to start increasing this again. It's back to the trend line, and probably needs to be a little bit above the trend line until the baby boomers about halfway through retirement. Now, I think they should do this again, just fix the whole system. They haven't called me, but I've called some of them. I've sent letters, I sent notes. I'm going to write a few articles. Probably ignore me. They probably don't know I exist. But I have been pretty right. And my guess is at some point we get another lump like that. And that's what they use to fix Medicare and Social Security. Whether they do it as part of a reform or they do it as part of an emergency, I don't know. Typically, we wait for a crisis, scream, thump. Oh, gotta fix it. Those other guys broke it. Whatever. They've all broken it. Neither the Democrats nor Republicans have fixed the system. In fact, since 1981, they've just been systematically breaking it and kicking the can for 44 years. Hear me now, believe me later, I guess. So I think we get down to the lower 500s no matter what on the S&P 500, and I think the healthiest thing is the middle 400s on SPY, middle 4,000s on the S&P 500. And this down here, under 400, under 4,000 on the S&P 500, under 400 on SPY, this is massive support. Massive support. Actually goes back to 2019. I don't think we get below this level. But if there's a catastrophe happening, yeah, we can get all the way down here. We can get all the way to 300. I don't think we do. I don't even think we get to here. I think somewhere in here is where we end up. The Magnificent Seven is the most crowded trade. It means that's the easiest place for people to sell and raise cash. It's also a place that you'd want to focus on buying. The NASDAQ 100 QQQ, which just added Palantir, is a great place to invest. So if QQQ gets down towards 400, which is what I'm hoping and thinking is about right, then we need to look at QQQ because those are the best companies. QQQ has outperformed SPY over every 2-year period since 2002. Not every single year. I think there's 3 or 4 where SPY won, but over every 2-year period, QQQ wins. And it's especially been winning since 2015. Right now, market breadth has been falling off a cliff. Those of you who are with me remember when I said when this gets above 80, usually get a correction. So market breadth has been shrinking, but the biggest stocks have held the averages up until today. Market breadth is getting pretty low. It's due for a rebound. I'm not a real big short-term trading guy, but an options expiration this Friday, the 20th, it usually spurs a rally into the end of the year. And then the start of the year usually starts out good. And then going into the end of January, we'll see. If January ends up being up by 2% or more, usually it's an up year. I think actually it's 93% of the time. If January is up 2%, and I could be off a little here, stock market is up for the year. If it's between 0 and 2%, kind of a coin flip. If it's a negative in January, almost always a negative year, something like 70%. I'll pull those numbers from Trader's Almanac at the end of January when we know. But because a lot of stocks have already corrected, and it's just the big ones that have to come down, I think this part of the correction we're probably almost over with. Get a little rally, and then we get another shot, another kick to the gut. Whenever we get that kick to the gut next year, you probably want to buy it because we just keep getting closer to the end of quantitative tightening and a resumption. There you go. Where's my where is it? And a resumption, money supply going up, which will grow the economy. It always does. Long and variable lags, a few quarters in either direction, but you generally want to buy those corrections. Historically, that's been true since the 1940s. Pretty good barometer, pretty good data set. So we are at the peak of decliners leading advancers. So again, that speaks towards a little bit of a rally coming. I'll probably sell some puts and some covered calls. I like selling options to collect premium and maintain it as close to a neutral stance as I can, given the uncertainty going into next year. Understand that. Option selling can help you manage your risk and remain more neutral than if you were just pure long or short the market. And since most of you are not traders, you should not even try to short the market. Cash is your best hedge, really. So if you can learn how to sell a cash secured put and a covered call, you will have an edge on 90% of the market participants. It is that valuable a tool to be able to sell options, not buy options. Buy options is for speculators. Selling options is for insurance company executives. Insurance companies usually get pretty big, don't they? Just keep collecting the premium. Do it based on technical indicators to keep you from making big mistakes. They're not perfect. By using good technical indicators, by respecting this sort of thing, and this is as basic as it gets, by respecting this sort of thing, you don't even have to be able to do it from scratch. You just got to understand it when I explain it to you, or Shooter explains it to you, or Teresa explains it to you. You can beat 90% of the people out there. And I know this because I see it happen over and over again. There were people in our services this year who made 60, 70, 80, 90. I think the highest person I heard, they said they made 125% this year. They trade more, but a lot of people made 30-something% without doing much. Sell some options, owned a little bit of Bitcoin, got rid of our loser stocks that weren't performing, mostly in September, some in October. Sold some covered calls that are starting to expire, so we just get to keep that money. Sold a bunch of cash secured puts, so we bought stuff we liked cheap and at a discount because we collected premium. And a very important tool. So the shortcut is to watch the dollar. I've been putting out this chart for a long time. When the dollar is in this yellow area, that's the Goldilocks zone. When it's in the green area, especially if it breaks out of the green area, or in the red area or breaks out of the red area, get some problems. Today, the dollar surged above this level, and we got a 3 or 4% correction. Down here is very, very recessionary. See, it happened during the financial. So if the dollar can very gently work its way down, maybe because they print money, it comes down once in a hunk. That's really good for the economy. And because the American economy, because American exceptionalism is real, and if you don't understand that, look it up, learn something about it. We have advantages that no one else in the country, in the world has, and they can't replicate it. Russia could if they weren't so corrupt in the government level, because they have the resources that we have. If they had our rule of law and system of government, Russia would be a powerhouse. If we ever see that that's going to happen, invest, invest, invest. So as this dollar comes down, we'll want to be invested a couple of different ways. Small caps start to do well finally. Bitcoin, I think, is in the early phase of adopting as part of the global currency system. Probably goes to between 15 and 30 trillion in market cap. It's at 1.5 right now. So Bitcoin is by the dips. Just hold on to it. Hodl, hodl, hodl. For those of you who don't quite get Bitcoin yet, I put some links in my article that you can read right here. These are this is the original paper. These are some recent articles. Bitcoin is a hedge for other nations and for companies against the dollar really being too strong for the most part. Because when the dollar is super strong, we're exporting inflation to the rest of the world. When the dollar is really weak, nobody else's economy works. So we need a dollar in here. But Bitcoin is the hedge against this and against this. Gold is about a $20 trillion market. I think Bitcoin gets into that area. It appears, and nobody's verifying it yet, but it appears that China included a little bit of Bitcoin in an oil transaction with either Qatar or Saudi Arabia, meaning that while they're not buying pizza with their Bitcoin, they're buying oil. That's pretty important. International settlement of oil has been 90% plus dollar up until the last 5, 6, 7 years. Now it's about 70-something% in dollars. The rest is the currency of the country buying it, some gold, some Bitcoin, some other currency. The Middle East is diversifying their currencies because they know that oil isn't forever. They've talked about it. They think we're at peak oil in 2040 and then it comes down from there. I think we're at peak oil by about 2030 and it comes down from there. Regardless, it's going to be a shallow drop because cars last a long time. We won't be driving EVs or hydrogen or whatever replaces ICE cars in mass till the 2040s. Now, the growth rate is already through the roof, even though Trump probably slows it down for a little while. One of the lessons I want you to understand is that the EV companies are probably in trouble, but the legacy car makers probably are in good shape. Why? Because they'll keep making money on gasoline cars, and when the pure EV companies lose money, and almost all of them except Tesla probably, well, and some of the Chinese companies, but a lot of the EV startups are going to go bankrupt. Take a look at a company like Lucid, which has Saudi money behind it. It could survive, or the Saudis could use Lucid to get part ownership of a company like Ford or GM or Volkswagen. Then you have the Ford Lucid model, or Rivian, the GM Rivian, or the Ford Rivian, the Volkswagen Rivian. So as the EV companies go under and they end up getting merged into other companies, think about how strong the legacy car makers come out of this. You've seen that Honda and Nissan are talking about a merger. Why? It's because they know that the Chinese are very strong in EVs. The way that the energy transition works out, which is going to be delayed by 4-ish or 5-ish years now, slowed down, not stopped. But the things that I thought would happen in 2026 and 27 probably happen in 29 and 30. Because one of the things that's coming after the washout in EVs is when we do finally get a big recession, what program will they do? And especially as the next hurricane hits Florida and people go, oh my God, they'll do cash for clunkers again. Cash for clunkers is coming again. I don't know when. Market, 2024, December. Kirk said. Actually, I've been saying it all year. But it'll happen. You can say, hey, I heard that before. So for 2024, what's my game plan? Pretty simple. There is still a chance that we get the Goldilocks scenario. Unlikely. Government likes a good crisis that they can fix. So we'll get something. So I like QQQ. Looking for a chance to buy that because those are some of the best companies in the world. The momentum-based ETFs have outperformed over virtually every time frame. So if you just like the idea of having S&P 500 correlation, buy an S&P 500 momentum-based fund. I've got one on our list. Same thing for mid caps and small caps. There are some quality factors that also win. So we have picked out some really good ETFs that will beat their indexes by 2-3 points over time with a little bit less risk. It's about all you can ask for with ETFs. The rest of your asset allocation has to be picking the right asset classes, industries, nations, and ultimately as the dollar comes down at some point, international investing will come back. Not really been the place to be as the dollar was on this huge bull market that I said would happen. Back here when I called the bull market in the dollar, everybody told me I was nuts. And yet now it's gone up for 12 years. Now I'm saying it's going to chop around. I think they're going to get into this yellow zone because they're going to have to print some money to fix Social Security and Medicare. And that'll bring the dollar down temporarily for 5 or 10 years. Then the dollar will get stronger again. and we'll see what happens in the 2030s. I like international investing in countries. They have a rule of law, sovereign security for the most part, a younger population that's educated, right? If you have a younger educated workforce, you have fewer people dependent on the system, right? Welfare and older folks. Natural resources are always good, very good, right? OPEC. Infrastructure they're not incredibly in debt on, and technology. So you take a look at India, clearly a winner. Southeast Asia is becoming very wealthy. Whole TV show or movie about that. Latin America, I think, is going to be spectacular. I think Venezuela, Argentina, Ecuador, El Salvador have all been doing the right things. Brazil, on and off. They're having a crisis right now. When the Brazil crisis is over is probably the right time to invest in Latin America because they're all pretty correlated. I think it's probably worth investing in Saudi Arabia. Got to figure out how to do it. The super rich are doing it. Play poker with some guys that hang out in the UAE, so I'm going to have to talk to them. Probably won't see them till June. Australia, big resource provider, supports China. So for all these speed bumps that we could hit in the short term, everything still looks pretty good to me over the next decade because there's a fix for everything. This wall of worry always gets climbed. Might fall off once, then you climb back up. Buy the dip has always been a good idea, but a dip is a double-digit correction. And then you have to determine, is it a recession dip, in which case it's going to be 30% more, or is it just a pause that refreshes? I think the one that's coming is kind of in between. I think it's going to be a mini recession, unless Powell surprises me and he just keeps lowering rates a quarter point every meeting. If he does that, then rates are down by a full point by spring, and we're in good shape. I do think that they want to see a correction, though. So I think they skip at the next meeting. His rhetoric today set him up for that. So I think he's going to give the market the jitters through April, May, and then he's going to come riding in, right? Boom, boom, boom. I don't really want to see that hole in construction. And I worry about unemployment getting away from us. I'd rather have 5% inflation than 7% unemployment. They don't ask me, though. Somebody asked, is the petrodollar really dying? Yeah, a slow death. Think of it like somebody's going to live to 100, and right now, petrodollar started in the 70s, so it's 50 something, right? That's the petrodollar. It's not going to fall off a cliff. I mean, maybe right at the end it does, just like we do, right? We kind of have this glide path, and then we fall off a cliff the last year or two. That's what the petrodollar is going to do. 2030s, 2040s, 2050s, I'd say 2040s, be my guess. Pick a decade either side. I'll take the spread. I'm using the intermediate term bonds as my holding place for cash. Although at Schwab and Interactive Brokers, we have money market accounts that are well over 4%. So I keep a big slug in those money markets too. If you have a money market in the fours, go ahead and use it. But I do have the intermediate term bond fund, IEI, in certain accounts, including the 401k. It's what Buffett's investing in. It doesn't have a lot of sensitivity to the long end of the curve going up. And because of what I explained with 5-year rates being instrumental in construction and building and even in business development, those 5-year rates have to come down a point. So even if you're a little underwater short term, you're probably going to make a small capital gain. And you just got to pick that spot if the stock market is correcting when to sell it so that you can buy stocks cheap. A little bit of finesse it'll take. All right. I got that done in about an hour. I feel pretty good about that. I do think that people underestimate the idea of never waste a good crisis. It is hard for government to act because the majority of the U.S. population is not super sophisticated from a financial standpoint. You ask them how to cook something, how to make a drink, how to fix a car, how to do their job, smart as hell. Comes to economics and finances, I think we take a lot for granted because hard for us is pretty easy for everybody else in the world because we do have it pretty good. Not that there aren't some great vacation spots out there, but it's tough to not want to live in the United States. So I think if we get this 15 to 25% correction in 2025, maybe it just started, it's a buyable thing because at some point they are going to print a lot of money. They're going to do a lot of QE to just fix the entire retirement system. Whether they do it incrementally or in a big hunk or two, I don't know. I think there's smart ways to do it. I think Trump could do it. I think Trump, if it crosses his mind to do it and he gets a bug in his ass to do it, it'll get done. Got to convince him. Somebody's got to convince him. Or we muddle through and we do QE periodically, or we just wait for a crisis in 5-6 years, 4 years, 5 years, 6 years, whatever it takes. But we're at peak baby boomer retirement in about 5 years. And that's when the screws start to get tight. People complain about the government not being efficient. Oh, they're going to cut $2 trillion from the budget. You better hope they don't. If they find a way to cut $2 trillion from the budget, it means that they have gutted Social Security, Medicare, and defense. It'll be a depression. There is maybe $200 billion they can cut. Maybe. If they combine Medicaid and the Medicare, that is the only place where all of a sudden you come out of it $500, $600, $700 billion to the positive. Because Medicaid is broken. Medicare is not. So just like a winning stock and a losing stock, kill the losing stock and merge it into the winning stock. Merge Medicaid into Medicare. If they do that, Trump care, there you go. Bernie would bless that. There's ways to fix things. I don't know if they do it the smart way or the panicked way, but it'll get done eventually after we've tried other things, probably. Any other questions before we call it a night? Quantum stocks, third person to ask. So I talked about quantum stocks at CES 2020. So 5 years ago, I talked to you about quantum stock. Who are they? Google, IBM, Microsoft, Amazon, Hyundai, bunch of companies. Quantum will never really happen because it is random. That's what quantum means. It's random, light. They'll never really perfect it. However, they will consistently move in the direction of getting better and better. So computers are going to get 10 times better, fast, and then 100 times better, fast, and then 1,000 times better, fast. That's going to have a tremendous impact on AI. AI is good to great right now as they incorporate it. Go from large language models to large quantum models. Take a look at Sandbox AQ, and computing power goes up, and they figure out the energy equation to not burn out the planet, which is largely going to be solar and someday fusion. I think we're finally within 30 years of fusion. They've been saying that for 50 years. Finally get cheaper energy in the next decade because technology is getting that good. I predicted the other day that Pfizer or one of the other big oncology pharmas is going to make huge breakthroughs in cancer so that it ends up being treated a lot like AIDS, heavily suppressed, largely avoided, cured with an ongoing bill. What the AI has already done with proteins and DNA, imagine what they can do with computers that are 100 times more powerful. Right now, computing power has exceeded Moore's law, right? Where the cost of computing came down 50% every 2 years. It's twice as fast. Now it's just doubling every year. I think I got that right. Way faster. Computers are improving faster than Moore's law. Quantum is part of that. And the path on quantum gets us there. Now, do I think you buy the quantum stocks? If you can find a few of the teeny tiny one or the small caps to have something that nobody else has and they're going to get bought out, sure. But big companies got the money. They got the brain power. They already have AI. They have a head start. It's a big head start. I think ultimately the winners from AI and quantum are the users like industry and pharma and finance. You want to find companies that use AI well because AI is just going to keep getting better, right? So yeah, there's a couple of quantum stocks and one in particular I should have bought last year. I missed. Oh well, such is life, it happens. Most stocks will not profit during a recession. It's just the way it is. That's why you want to hedge with option selling and heavier in cash and a couple of bonds. Sometimes preservation of capital supersedes appreciation of capital. And I think until we get a 15 to 25% pullback, that's probably true. You don't have to time it perfectly. You scale out now into the strength of the market over the next few months. And then you buy after it takes a pretty good header. You don't have to catch the tops and bottom. You just got to put a gap between your line and the index line because the index averages about 10% a year. So if you can put 5 points between you and the index once or twice a decade from avoiding risk once or twice a decade, that's really all it is. How often do I say tighten up? Not often, a few times a decade. And then you have good selection and good asset allocation. You can put another 3, 4, 5 points in the way. And if you're a good option seller, you can add another 5 to 10 points every single year. I think that every single one of you should be able to average 20% because you have the advantage of only managing your money and you're not regulated. My handcuff is that I got to be real careful that if a regulator takes a look at what I did, they don't have a problem with it. You don't have that. You have more freedom than I do. But I'm a better trader than all of you. Kind of evens out. So you can hire me. You can read my investment letters. Try to understand what I'm talking about. But 20% I think should be your bogey. And that's over a 5 to 10 year period. And that'll come from having 1 or 2 huge up years. Then the rest of the years, you kind of float around the averages, try to beat it by a few points. All right, let's call it a night. And yeah, if you're not a subscriber to any of the letters, jump in. There's specials running all the time through January, through my birthday in February. Heck, there's always a special. So it's impossible not to get 20 to 30% off or 50% off one of my letters at some point. All right, have a good day. 2025 will be choppy, but it's not going to be horrible, probably. If it gets horrible, hey, then we just buy even lower. All right, take care.